Hey, good afternoon, everybody. Chris Lester here. Thank you for joining us on our weekly chat with Chris. I want to give you enough information to stimulate some thoughts. If it applies, great. If it doesn't, again, don't keep me a secret. So without further ado, long-term care. First of all, we have to understand what long-term care is. And in my experience, what I find is people can relate to long-term care as a need when they know somebody where it's happened to or where they've experienced it firsthand. So an example is, for me, my grandmother needed long-term care. I've had clients that have needed long-term care. And as I was taking my certification for the RICP, it really stood out to me that the possibility of bankrupting a well-laid retirement plan just because of the rising costs of care. And we have to learn to differentiate what the care might be for. So long-term care is a range of services, but it's when you can't perform 2 out of 6 of these ADLs, and ADL stands for activities of daily living. So if you cannot bathe yourself, if you can't go to the bathroom by yourself, incontinence, if you can't get in and out of bed, transferring, right? If you can't feed yourself or you can't dress yourself, you are a candidate for long-term care. So how does long-term care affect your family and loved ones? Well, if you have no plan in place for long-term care, your family will provide the care. And that care and responsibilities are generally not shared equally. Tensions and resentments among siblings. I got a lawsuit going on with one of my clients right now that is dealt with that firsthand. Own careers and families are disrupted. And then long-term care can tear families apart, as I just mentioned. So question number 1 that we're going to ask here is, you may never need care, but if you did, how would that affect your family? So there's 4 important factors to consider when a loved one needs care. The first is the spouses. The stress of caring for chronically ill loved one can impact the health of the caregiver as well. The next is obviously if you have children. Caring for a chronically ill parent tends to affect their career, their marriage, and their own children and family obligations. And we get torn in multiple directions. Then you have family dynamics. When informal care is needed, it may not be shared equally amongst the adult children. Often one sibling bears the heaviest burden, which can affect the relationship amongst other siblings. And that's what I'm seeing firsthand now. And then unnecessary losses. Not all losses can be avoided. However, the unnecessary emotional and financial losses that can be mitigated when your clients are well prepared. So long-term care, who is affected? Well, 7 out of 10 people over the age of 65 will need some type of long-term care support. That's that 2 out of 6 ADLs that I talked about. It's not going to be today. If you're 65, maybe you might have onset of dementia or Alzheimer's, but typically it's 10 to 15 to 20 years from now. 63% of the caregivers use their own retirement and savings funds to pay for their care. So if your caregiver is, say it's not your spouse, but your children, they're now redirecting resources to take care of the aging parent. But 100% of the families are affected in some way. So question number 2, if you did need care, how would you pay for it? Well, we can always count on the government. The government programs such as Medicaid, and Medicaid, that those 3 letters at the end, AID, may require them to spend down their assets first. Most qualification thresholds that I've seen in my career is you must spend down your assets below $2,000 in order to be eligible for state Medicaid programs. So think about that. And there's a lot of strategies that you may be able to implement to sort of be able to qualify, but just understand that bar is very, very low. Now you could go out and buy long-term care insurance. In many cases, traditional long-term care can be very expensive. And that's one of the things that I've seen in my career is that this is a relatively new insurance aspect for the insurance companies, and they've mispriced the products along the way. Genworth, had, I think in 2015 or maybe it was 2016, had like $6 billion in losses due to claims. One of the leading national long-term care insurance companies stopped writing for federal employees, right? Like John Hancock, right? Just stopped selling it. Most of the major players that were writing and tried to step foot into this arena, it could be Allianz, could be Prudential, could be MetLife, have all exited. And the reason is because they're getting hammered in claims. The actuaries misprice the products. And one of the things I've learned in my career is that quite often the policies that were sold 20 years ago, 15 years ago, 10 years ago, even now, right? If you were to buy a traditional long-term care policy, unless you buy a hybrid, the rates aren't guaranteed. So you could turn around and at 60, 65, you say, yeah, we need it. We know we need it. Something just happened to mom and dad. We want to make sure we're covered. You go ahead not knowing what you don't know, and you say, we can afford $3,000 for a husband and wife or $4,000 a year for a husband and wife. And you go, now we're covered. We're good. But what you didn't know is those rates weren't guaranteed. And we're seeing that the rate increases that the insurance companies are handing policyholders 5, 10, 15 years later are growing astronomically. And the only choice at that point in time, unless you want to be completely uninsured, which defeated the whole purpose in the first place, was to reduce benefits. And then you have self-funding. Requires them to pay out of pocket all the expenses. And this is, I don't care how much money you have, but it can be a very, very expensive proposition to try and self-insure. So the unpredictability of long-term care, these are just some stats. There's a lot going here. I'm going to start to the left, which just talks about how long, right? We think about averages. So if you just look at the yellow side of the chart, 48% of people that are 65 years and older who need some type of long-term care are less than 1 year. So 50%. That means 50% need a longer time frame, and it's up to 5 years. Here's what I can share with you based on my experience. It is not called average term care. It is called long-term care. And if you know anybody that has either suffered from Alzheimer's or from dementia or Parkinson's or some type of prolonged congenital disorder, it can be just not only taxing, but just devastating. Now, how much? Well, we live in the Northeast, but I was shocked to see that even, higher than New Jersey was Connecticut at $150,000 a year. And that's in today's dollars. So first of all, if you needed it for 1 year, do you have $150,000 set aside for yourself to pay that bill? So your options are we can move to another state where maybe it's less expensive, or not get sick for another 5 or 10 years, or spend all our money. So it's just, the problem just by neglecting it or not paying attention to it does not go away. We have to understand that these rates or these costs are going up, and they're quite likely to be much higher 5, 10, 15 years from now as medical advancements happen and longevity happens, right? So your costs, right? So 1 out of 4 people now, age 65, will face over $50,000 in lifetime out of pocket. My study that when I was looking at is that a family today that is retiring, husband and wife, 65 years or older, should have $400,000 set aside for long-term care needs, right? So it's just we don't know what the future holds, but to plan properly, we should really take a hard look at this. Will Medicaid pay for long-term health care? Yes, but you must qualify both medically and then, like I mentioned, financially. The threshold is $2,000. Will health insurance pay for long-term health care? Possibly. So limited services similar to Medicare. So what you have to understand is that If it's not for skilled nursing, those activities of daily living quite often aren't covered. They're never covered, right? So if it's for skilled short-term and or medically necessary, yes, your health insurance could pay for it. Other long-term care options, you can self-insure, pay as you go. You could purchase traditional long-term care insurance. I'm going to talk about here now something called asset-based long-term care insurance. You have these hybrids that I was talking about, life insurance combination plans, and I'm a fan of those. And then depend on family for care. So traditional long-term care insurance, it's based on your age, your insurability, the daily or monthly benefits. So think about it as if we had a crystal ball and we knew that we were going to have an average stay of 3 years and it was $100,000 a year. That is a pool of money, just mathematically, 3 times $100,000 is $300,000. What they do is they divide that into a daily benefit. So when you see quotes, it'll say, hey, it'll pay, $200 a day or $250 a day, or it'll have monthly benefits that it'll pay X amount of dollars per month. Then it'll give you a time frame, coverage period. And this is why the next slides that I'm going to show you is I've been introduced to a product that when something is good in the industry, I tend to shout it from the rooftops. And I was introduced to a product that I think makes traditional long-term care look very obsolete. Then they talk about the number of days until coverage. That's like a deductible elimination period. A lot of plans, inflation protection. And then do they offer shared benefits? Here's one thing I will tell you. There's not a long-term care plan, traditional long-term care, that will do joint lives. They might give you a husband and wife discount, but they will not do joint lives. So that brings me to this product. This product here is written by One America, and it's a whole life contract that uses an annuity to hold the money to take and utilize money from a qualified plan. Qualified plan, if you recall from some of our past sessions, is any money that's in the IRA, 403B, 401k, those types of things, things we have not paid tax. So what's interesting is that this company, A-rated company, been around for a long time, has said, look, here's what we're going to do. We're going to trade an asset. So what you're going to do is we're going to give you an income rider. We're going to give you a 20% bonus, and then we're going to tax it as you take the money out of the account. So let's say you have, and again, this is the thing I want to make clear. If all the money that you have for retirement is $150,000, this should not be your plan. This is money that is probably we can carve out of your retirement plan to put aside, to put to work, to be there should we need it. So if you were to trade an asset with the insurance company, $150,000 of your 401k or IRA, we have not paid tax on that money. What they do is they're going to give you a 20% bonus. That bonus on this example is $30,000. So now you have $180,000 that can be used towards the purchase of the long-term care benefit. Now, that they're going to, in order to defer the taxation of this, because this has not been taxed yet, they're going to pay the premiums to the whole life contract, which has the long-term care features on it, and it's going to pay $18,000 a year for 10 years. So you'll see, as this starts year one, we took out $18,000. That went to the pay for the long-term care. Premiums can never go up. And now as this continues to get paid out until it reaches zero, now your contract is fully funded, no more premiums. And now let's see what that might offer you in the way of benefits. And here's where I get just amazed. So you have $18,000 that you've paid into, and it's bought a life insurance policy that has a death benefit of $176,246. So listen, you have a bad day, you get hit by a bus, then there's a death benefit paid. But this, remember, was money that we are setting aside for long-term care. So you'll see that total initial LTC, the face amount payable for long-term care is the first 10 years, and then after its continuation of benefits. Folks, this pays for per person $52.87 a month for life and on 2 people. I've never seen a contract as strong as this. Now, if you never use it, eventually you're going to pass away, but a death benefit will get paid. But just think about it. If both of you were to go out on claim, that could be $10,000 a month, $120,000 for each person for the rest of your lives. Not 3 years, not 4 years, not 5 years. This could, if you go out on claim and had Alzheimer's, could be for 20 years. So again, it's just a very strong product. I think it's worth something if your portfolio allows. If you have some money squirreled away in your 401k that you're saying, hey, I don't even need this money, it could be a way to help protect your legacy to your children. So folks, this is what the math looks like. It's a little busy here, but it's the $18,000 is on the left side for 10 years and no more premiums. This is guaranteed. It's a contract. It's a whole life contract. Premiums are guaranteed. Nothing changes. And then all the way to the right side is the monthly benefit. So it's $52,000 or $5,200 a month for 10 years. And then it goes to that last column, which is the COB. If you're out on claim for more than 10 years, it'll pay 15, 20, 30. That's the rider. So notice that total long-term care balance is unlimited. Unlimited. And at the bare minimum, your death benefit is never less than $176. So to me, it's just a way to trade an asset to an insurance company, mitigate the risk. It's something that should be looked at and considered. So a life insurance combination plan, these are the other types. I've been offering these for years. I call them live, quit, or die. These are great contracts as well. So basically, if let's say you had money, $100,000 sitting in a CD, and you turned around and go, you know what, the CD's paying me next to nothing. I'm getting 0.5% at the bank. Well, you could trade the asset to the insurance company, and you can be guaranteed to either get 80% of your principal back or 100%. And obviously, if there's a larger amount guaranteed back, then you'll get lesser of a payment. But it's just a good way to put something in place that if you, and should you need it, you have long-term care in place. And if you don't need it, there's a death benefit in place, because there's 2 things that are certain in this world, and that's death and taxes. And then lastly, if you did want to quit it for whatever reason, you're guaranteed at least to get your principal back. No ifs, ands, or buts. So these are, I think, the steps in the right direction from the life insurance community to use tax code to the consumer's benefit. I just wanted to share that with you this week because, next week we're going to talk about Medicare Parts A, B, C, and D, and what's covered, what's not. We're going to do a little bit of a deep dive on that. But I just, in my career, I think that these are, as we're talking about retirement planning, as we're talking about having that comfortable retirement, that we have to make sure that we put the infrastructure in place, that what if something goes wrong or not according to plan. So these are our disclosures that we put at the end of every session. And if you have any questions, obviously you can always reach out to me. But if the advisor that invited you on this call today, if you have any questions, circle back with them. They're happy to answer the questions. We all work together. We have a very holistic approach. Really want to thank all of you for being on the call and taking time out of your day to listen to what we have to share. Again, I hope all is well. Stay well and have a great day.